Hello and welcome to Profiles in Risk. This is your current host, Tony Cañas, and today I have a big panel with me, including the longtime host of the podcast, Nick Lamparelli, and a couple of others, James Riviviezzo. I think I did better before we started recording, and Roman Ryan. And today's episode will be different and interesting. Basically, back in November, I posted a quick 5-minute video saying that I don't care about Insurtechs as investments. And my main point basically was that I understand that they have to make a profit eventually in order to survive, like any other organization that's not a nonprofit. But I'm deeply annoyed at how obsessed we are, and this includes our own Insurance Nerd Slack channel, with them and their performance as investments. Because in my world, in my view, the most important things that insurance companies do is properly insure the customer and properly treat the customer, and be great employers. And only in a distant third do I worry about them as investments, right? And that's what led to so today's episode is basically James and Nick telling me why I'm wrong, and hopefully Roman helping me defend myself. But I'll give everybody a little chance to introduce themselves. I think the listeners know me, Tony Cañas, one of the co-founders of Insurance Nerds. I rarely talk politics, but I am a long-haired hippie, pinko commie bastard. Although I think of myself as a social democrat, but from the U.S. perspective, pinko commie bastard is a good way to put it. So Roman, we'll start with you since I think you're on my side. You're another long-haired hippie. I'll give you a chance to introduce yourself.
Yeah, we'll see how much we end up on precisely the same team. So yeah, Roman Ryan, I have been sort of a peripatetic strategy person in a variety of industries. Deloitte, PwC, Amazon, Plantronics, and made my way to the insurance industry later in my career. First at a mutual, which we'll maybe talk about that framing of insurance companies at some point today. And then at an Insurtech at Vouch. Now I'm a consultant and writer. Very excited to chat about all this. I think it's pretty interesting in the risk space, especially this question.
We'll leave Nick for last since he's probably known by the audience. James.
Tony, thank you so much for having me here. My name is James Riviviezzo. I currently lead business development for Rubizzo. We are a Insurtech company that has built a unified API for small business commercial insurance. My background is pretty interesting in the sense that I started my career in a different part of financial services than insurance. I began my career in asset management. I worked for firms like Merrill Lynch and UBS and made my way to the insurance sector about almost 15 years ago, starting at a company called Genworth and then moving to Marsh, Safety National, AIG, and now firmly in the Insurtech space with Rubizzo. I guess if you're going to identify as a commie pinko, Tony, I probably was one of the people you were railing against in Occupy Wall Street as a former asset management person, but I'll call myself the conflicted capitalist here today.
I love that description, by the way. I absolutely love that description. So, Nick.
So, hi, everyone. I'm the former host of Profiles in Risk. I am a longtime insurance nerd and currently just doing some strategic advising until more news to come on that. And I would if Tony is the pinko commie, I'm actually not on the other team. I'm on my own team. So I am definitively libertarian capitalist, and I think that's the only long-term scalable position that actually works. So I said it.
And we are recording. Thank you everybody for introducing yourselves. We're recording on an interesting day. It's January 22nd, 2022. 2022. And just a couple of days ago, Root downsized 330 people. It's the first big Insurtech downsizing I've seen recently, and all of the main post IPO Insurtechs are, you know, in their stock price in the toilet, basically, right? Like, I don't think a single one of them are actually above where they IPO'd whenever they IPO'd in the last couple of years. So as investments, they definitely thus far have not paid off. So that is what it is.
Well, you should probably segment this by saying they may have been a good payoff for the initial venture capitalist and seed investors for those companies. But once they entered into the secondary market for institutional buyers as well as individual investors, they have been thus far poor performers.
And I've got to say, if I'm not mistaken, the lemonade one especially, if I'm not mistaken, somehow it was underwritten in such a way that the founders were able to get out very, very quickly, while normally there's like a 6-month delay before founders can sell. Or am I incorrect in saying that?
That's not exactly what happened. It was a traditional mechanism, timing mechanism. And what happened, Tony, was around the time that they had the opportunity to begin divesting their shares, all of the quote unquote meme stock, that paradigm started occurring, where you had, I'll blame, you know, like the Robinhood investors that were all bandying together and basically driving up the value of these disruptive, revolutionary, and even stocks that were being short squeezed. They were banding together to move the market, and they moved Lemonade up to significant valuation, like upwards of $10 billion. So smartly, the leadership of Lemonade did a second offering. And it was that second offering that the original investors were able to slide their shares in and make their shares available to the public. So they got out with it on an incredible deal, but it was the investment world that planted the seeds that was the fertilizer that allowed that to happen.
Okay, thank you for correcting me on that. I'll quit bad mouthing them for that move then. Yeah,
there are plenty of other things to badmouth them about.
I am actively pursuing them as a client in my new role, so I do have to be a little bit more careful with everybody that I used to be.
They're not here to defend themselves either, so it's unfair.
Correct. I still think their UI is beautiful. And I will say, I had a conversation yesterday with a traditional insurance person that's now working there at a fairly leadership role and been there for a year and a half, and she's loving it. Like she feels that she's being treated really well, and that she loves how the company's working. So
I'm sure.
So on that side, they fall on my good side, right? Since I care more about how are you treating your employees than is you as an investment. So I'll give them credit where I think they deserve credit. So I either Nick or James or Roman, if you agree with them, feel free to pile up. But why does it matter how they're doing as investments from your perspectives?
I'll start.
Who wants to take this one?
I'll start. So why does it matter? It matters more in some cases than in other cases. In this case, it matters greatly because it was venture funded, right? I think that changes the dynamic quite a bit. And the poor performance was, I'm not patting myself on the back for predicting this. The poor performance is because it's got a poor business model, right? And so there was an incredible, I wrote the article, Don't Believe the Hype, when they were initially doing their seed to Series A funding. And I saw the hype to begin with, and it was Tony, a lot, it was quite a bit, basically checking the boxes of all the things that I guess a younger generation would tickle someone like yourself, right? It's just like, hey, look at us. We're going to be a different insurance company. This isn't our money. Where, you know, where we have no incentive to not pay claims. We're going to peer fund this thing. Like, they were just like checking off all the boxes to me to build up the hype around it. But when you kind of dug in a little bit, it was just like, but they don't have a business model. Like, there's not enough there. There's not enough there to justify the venture element. If those folks wanted to go on their own dime with massive skin in the game, they're a completely different story. But once it became venture, I started this. So I'm a capitalist at true heart, but I would say that this is one of the side elements of caveat emptor, right? Like, this buyer beware around this. They were checking boxes and pulling levers to get people to hype it up so that they could make it venture worthy and get it to the finish line where they could get out. That was obvious to me, but I think there was an entire generation of people that were completely fooled by all of the messaging, and it was just like they didn't want to do the homework to kind of dig into the details around that. And I think they're getting exactly what they asked for. This is the true nature of capitalism. They bought a story that wasn't true. Now they're going to suffer the consequences for it, and rightly so. And maybe they'll learn their lesson and it won't happen again, but it will.
I've got to say,
that's why.
I ate it. I ate the line, hook, line, and sinker. I think it's the saying. I'm not a fisherman, but yes, the millennial honey they were putting out marketing wise, I completely bought it, and I think I now understand why you saw from the beginning what I didn't see, which is I kind of thought that it would be a not a venture play, that it would be, right, they're building really cool UI. Eventually they'll get acquired by a carrier for the UI, and finally we'll modernize our UI, right? It'll wake carriers up in that they need much better UI, basically.
And that happened. So you know, Tony, one thing I try to do when I evaluate businesses is I try to figure out what is the value that they're bringing to the table. That is extremely important. There's no doubt the things that you talked about at the very beginning, you know, are they servicing their customers and do they treat their employees well? That's important to me too. How much value are they bringing to the table, to society, right? But in terms of like an actual investment or the quality of the business, it's really how much of that value they capture that's important, right? And so I even stated it in my article that I thought that they would be able to deliver value, right, to potential stakeholders, but a real good investment and a real good business delivers values to multiple stakeholders, including investors, and it generates a flywheel where it can endure going forward. I'm Micah Cooper and I were on a private DM on Slack, and he was asking me if I was going to jump into Root, and I said I don't think so. Like, Root might be on the negative death spiral. Like, Root may not be salvageable. It's not a good business, and that's the problem when you focus your value proposition on a potential set of stakeholders or not all stakeholders, is that I think Root might be fatal. Lemonade is going to be in trouble. Lemonade is burning so much capital. They're going to have to go out and raise more capital, which is going to put more downward pressure on the stock price. I don't think they're doing their customer base or their employees any favors. Like, I think I can almost see a game of musical chairs where at some point, if you can't get the capital to keep coming in, it's going to fall off a cliff, and it's the end story. The game's over for them. So my view of these kinds of investments is that ultimately the investors have to win somehow in this, because you want them to, so that they can continuously feed more capital, so you can keep growing and keep delivering that value to those other stakeholders. It's a flywheel. It has to have that particular dynamic. If one piece is missing, then the flywheel just does not have the same momentum.
There's almost like a hypocrisy that goes into the term Insurtech and the sort of marketing notions of a company like Lemonade, where like the key value proposition of an insurance company, certainly technology is important, but we're not talking about like a pharmaceutical company where the like tech inside of the pill is the key thing. Like doing a holistic thing that like includes money and technology in the insurance space. It's not purely reliant on technology in the same way that a company like a pure software company is. And in that way, I don't think it responds to the dynamics of the venture space in the same way that other plays do. And you end up putting a lot of people who don't understand that in like a difficult position when you convince them that you actually are something that you're not.
Yeah, I agree with that.
You know, what I hear from Nick is this idea and premise that you know, the Insurtech moniker is a pretty broad brush that a lot of different companies get painted with, and you know, they have to have a real salient business model or a differentiating factor to warrant not only private investors but also the trust of public investors that might buy a slice of that ownership in the public markets for those companies that have exited private ownership, if you will, and taken advantage of SPACs or other IPO mechanisms to become publicly traded companies. It's a little bit of a deal with the devil in a sense, right? You have to figure that keeping your private status and using private funding through venture capital entities or private equity or whatever the source of that capital may be shields you from the scrutiny that a lot of these entities are now experiencing. So I find that aspect a little bit intriguing as well. So maybe food for thought there.
So I'm a big fan of the mutual model, or at least the idea of the mutual model. And I think Roman is right there with me. In fact, he's a lot more knowledgeable about the mutual model based on reading his blog. Would it have been possible? Is it possible to build a risk-carrying Insurtech? You know, probably starting as an MGA and eventually growing into an actual carrier without venture, like do it slowly, kind of thing, like bootstrap it slowly, use only insure, or maybe like funded by one of the carrier one of the carrier venture funds, right? Not like true like meets exponential growth venture. Is it possible?
Well, those funds have the same expectations that regular old venture capitalists do, so that's not a slowdown. But so you could. There is a way to build
Roman, Roman, I was just going to say, like they all come from Goldman and those companies as well. So like they have the exact same mindsets.
Okay, so not through them. Is it possible?
But debt, for example, if you were to start, say you were to start a mutual and you had a long enough time horizon to have the patience for that, there's no way you're going to build it up as quick as Facebook. But
of course, yeah.
And you look at State Farm and the big mutuals today, like they built up over 100+ years in most cases. And you could start a town mutual in Wisconsin, for example, with $200,000 in a bank account. You don't need millions of dollars, and you can get that through debt or grants. But I don't think you end up with the same incentives as you get if you're a founder of an Insurtech. and you end up in a situation where you can't spend the same money on software development to be the tech side if you only have 200,000 in a bank account that is meant to be risk capital.
But
maybe,
so let's
maybe
say
this is a maybe this is a an on-off ramp conversation, but I do find it interesting that I think clearly many of the companies that put themselves in the Insurtech category are structured as MGAs. They're accessing essentially someone else's balance sheet, but probably bring to the table the idea of a better business model. To Tony's point, maybe a better UI or interface with customers, maybe a better technology towards customer acquisition or customer service. And I have no problem with that, because you're essentially putting a front door on a legacy carrier's paper and capital base, but serving customers in a better way. And I have absolutely no problem. When you think about the mutual benefit that that occurs in that kind of paradigm, everybody kind of wins. The MGA wins because they're acquiring customers, maybe faster, maybe they figured out a better way to service customers' needs. And then the backing paper, as long as the loss ratios are looking healthy, it's a win-win scenario. What's confusing to me with my background that maybe skews some of this is I just don't understand why many of these enterprises are pursuing the idea of becoming a full stack carrier and taking on the need for the increased capital reserving and the complexity of becoming a essentially they want to be in the same category as those legacy carriers that they're looking to essentially partner with or beat. So that's something
because
that's
of TAMs.
What's that?
Everybody needs to get their TAM to be as high as possible, and that's how you raise the big money, even if you're not actually going from 0 to 1 in your business model.
That's true, Roman. But I think I think Lemonade actually limited their TAM by becoming a carrier, right? I don't think there's anything they did that they couldn't have done better, faster, or more broadly. Like I think Tony, I think Lemonade's structure, right? So what they were trying to do, like think of the check boxes they were going after. If they had gone the MGA model or the brokerage model, it would have been a better fit, right? Because their entire thesis was around like, aren't you the one that took the picture of the cab in New York City with like, hey, we pay our claims. We're not a traditional insurance company. We actually pay our claims because it's not our money. That kind of that kind of philosophy is a broker's philosophy, right? Like they are indifferent to it, and they will, their ability to use technology to connect buyer, supply and demand, I think would have fit so much better. And I view the MGA, Roman, I view the MGA model as having more ability. Like think of if Lemonade actually had like multiple carriers that they were partnering with, right? The amount of, now they can actually go after that growth in that way, right? And I think they'd be more secure, and they wouldn't have needed to raise all of that capital to start this carrier. Now I think that carrier is like an albatross around their neck. It's really dragging them down. All of the leads that they generate that don't fit into that carrier, they basically have to throw it away. Like, holy crap, it's so expensive to find a customer. They're doing all of this heavy lifting and hard work to get a potential customer, and most of them may not qualify. A lot of them will not qualify to be a customer. That just kind of breaks the dynamic down. So
it's a great point, Nick. It's not just TAM, it's also the number of cents on the value chain dollar that they claimed early on irrationally that they could own. And you get too excited about being able to do everything and fix everything, I think, in some of these situations.
Yeah. So my fear perpetually going backwards was that I just struggle to see insurance as a venture-worthy business in the traditional sense. If you look at best case scenario, best case scenario with Lemonade, right? Successful, profitable. What are their margins? Like, even if their margins are better than the average homeowner's insurance company, right? Those margins are paltry, right? And so they're only like they're only scratching off a few extra basis points. And Roman, as you said, there's the dollar of premium, there's only so much bandwidth that you can squeeze out of that thing.
Exactly.
So the difference between like a tech venture is that there's some promise of huge TAM, huge market share, and like 80% margins on the software or the SaaS model that you're building. There's no equivalence in insurance because the cost of goods sold, your claims, is always going to consume a significant chunk of your dollar of premium, and then the distribution cost is going to consume another big chunk of that, and then you got like this much left over. And that
Nick, you're making Tony's point. You're making his point, because Insurtechs as investments are not that interesting as a result.
I agree with that.
Because like if you're building a mutual from scratch, that's pretty interesting because it's weird and maybe no one could do it. If you're building like a blockchain based thing that doesn't have venture capital investment, that's potentially pretty interesting. But do those things even fall into the Insurtech category?
Yeah, I don't know, but I don't know. I look at when I examine the cross section of Insurtech, I've only seen a few that have sort of struck me as like, that's got potential, right? And the potential that you're looking for is something where they're in a space where they can make a significant value contribution. I'll name one that Tony's familiar with, but I'll name Ben and Kiva because I'm close with them and I've watched them up close. They were getting into a space that was not sexy, even in an Insurtech standpoint, which was like life insurance claims, right? Right there, like that got me really excited because it's like there's going to be no other competitors that are going to come into that. It's like so boring. But talk to Brent, talk to Bobby about that space, and it is like 1950. Like you're surprised. Like it almost sounds like they're using vacuum tubes to manage the processing of life insurance claims, and it was a lot more. The whole thing was a lot more. I don't want to say complex. It was a lot more. The customer satisfaction element of it was so poor, right? There were the situations where people would die and no one wouldn't even know they had life insurance. Like that sucks, right? Or there'd be a delay in the payment of the check. But Brent had that great story of why he started Ben Akiva, which was that he sold them that life insurance policy. The person died, and he, as the salesperson, was never informed about that. So he couldn't advise them. And by the time he reached them, they had already made like some significant financial decisions with the payout to that money. So the whole process was like really clunky and broken. So they come in and I see them as potentially being like the default standard, like basically redesigning the whole standard where every life insurance company almost has to use their technology in order to raise their game. That's the kind of thing I would look for in an investment. Like the tech has to actually do tech stuff, like make a significant leap and have economic fundamentals where you can continuously acquire more business, but the cost to acquire that business or the cost to service that business does not grow linearly with the business that's coming in. That's a venture-worthy business. Like those are the kind of curves you want to see. And technology was supposed to do that for insurance, and it has not really done that. So by and far, I think they're really bad investments.
I think I've kind of publicly, I always give attribution where attribution is deserved. I think it's our friends at Coverager, I don't know if it's Avi or who it is over there, that has made the statement that, you know, legacy insurance companies have a distribution problem, and that has translated into the Insurtech space as a business model problem, right? And I think that's what I'm hearing you say, Nick, is that a lot of these enterprises, and we don't have to name names, are essentially built on a little bit of soft sand, right? There isn't a strong foundation for a business model that can actually be effective and either sold back or acquired or ingested by the legacy industry to actually make those a worthwhile investment. If that's what I think.
That's what I'm saying.
Yeah, I mean, I think a lot of this is obviously fueled by the fundamentals of the environment that we're in right now, which is that money and the cost of capital is essentially free. And maybe it was not the right forum, Tony, to make the argument when you said there, you know, I don't care about Insurtechs as investments. There, I said it. I think it was your quote, and I took the opposing view to this. I'm informed by, I guess, the way that I was educated. I majored in economics, which, you know, pretty boring, pretty sleepy, but what is economics? It's, you know, the study of man's unlimited wants, needs, and desires faced with the conflict of limited resources. And I guess I get offended back on that premise of bad business plans or business models. I get offended because there is, in theory, a limited amount of capital that can go into funding, and this is in the venture space or the seed space. There's a limited amount of capital that can go into funding good ideas and enhancements to technology and legacy industries. We see that across all different segments and sectors. And when you see some of the valuations, even in the private market right now, where there's, you know, unicorns galore in the private Insurtech space, and we all consume the same media, and we see the announcements and we see the valuations, it's pretty staggering. You know, you can get a little offended at some point, and I'm not speaking for myself or my own company, but there's a limited amount of capital, and I think there are far more deserving enterprises and ideas than others, but we're in a carnival atmosphere right now where money is free. And if you or I raised a fund, if the four of us together decided to raise a fund, even you know, $1 million, and where are we going to divide that $1 million in investments? There are more deserving candidates than others, right? I think that's a pretty easy premise to come upon. But you're seeing right now money kind of being thrown at anything that moves, and I think that's a tragedy. Like, and that should offend all of us who want to invest in this industry and make it a better place. Like, I think it could be better allocated. Is I guess the premise that I kind of stand on. And when you see now how those exorbitantly funded companies based on a pretty poor business plan have then had the ability to go into the public markets, to Nick's point, I think they're getting what they deserve, you know, in that regard. And I feel very bad for the people that work for companies like Root. The announcement the other day, no one, and especially myself, I don't want to see people out of jobs. I don't want companies to fail for the sake of failing, but maybe they never should have gotten to the point where they were in the first place, which is just an interesting conversation that I don't know if enough of us are having in this industry. I think people should be rewarded for taking risks. We want entrepreneurs to raise their hand and jump into the fray, but not every idea deserves $480 million in funding, probably.
Well, I think we're talking about the difference between gambling and risk. Like, there's a difference between looking at a house in a place and saying, like, this is the way we evaluate the chances that this house is going to burn down, and the difference between that and saying, like, I'm at the casino and I'm going to put money on different numbers and hope for one of those numbers to hit and get a huge payout. And I think, like, one of the challenges that the insurance industry faces in general, and you all can disagree, but, like, I think the way that risk is framed by the insurance industry, we could do a better job of articulating to people that, like, the deliberate decisions that are made around risk and then the payouts that are made to people based on those risk choices are meant to, like, maintain a healthy society and, like, a community that when houses burn down, like, people have money to build them again. So I think a lot about, like, that, like, narrative, and the way that people like interact with that narrative. And I don't think it's incompatible with like sort of the libertarian capitalism ideal necessarily, but I do think there's like
It's
a
not.
need to like translate,
I'd love to
It's-
see a return to that. I'd love to see the birth of a technology first mutual that makes getting insurance beautifully easy, that treats its employees well, and that is not hurrying for exponential growth, which in our industry is just not a good idea. Your book never does well with exponential growth. Is that just not
It never does.
possible in our current environment, even though capital is basically free?
I think it's possible. I mean, you know, I'll have more news on that soon. But
Nick's
to
using
Roman's
this as a
point,
promo. Nick's teasing right now. He's teasing.
building up the drama. To Roman's point, like when I started my MGA, that was pretty much the playbook I did, right? Which was I started with the claims. I was like, what claims do I want to focus on? Can I get a competitive advantage in forecasting or predicting those claims? And then I worked backwards to what sort of product and how would I deliver it and who would I deliver it to? Can I make all of the numbers kind of work out? And this is just I think going to be the long-term challenge for insurance is that not everybody is our customer, right? So this you have a pool of money, right, that's used to pay your claims, and I think it's really incumbent upon the company to make sure that the wrong people don't get access to that pool of money. So there's always been that conflict in insurance of making sure that the pool goes to who was going to pay, but I think that conflict has sort of perpetuated itself for so long now that it's just standard that there's a lack of trust between policyholder and carrier. And that was one of the things that I liked about Lemonade, was trying to raise the level of trust on that. So break down those walls, raise the level of trust. And I think technology can go a long ways to doing that, but it still does not change the fact that, Tony, as you said, you can't have exponential growth. You have a pool of funds. You can't grow so fast. Like, you can't grow your pool fast, the pool of people that get access to those funds faster than the funds. And that becomes extremely challenging. And one of the things that is very interesting about insurance is insurance does not have winner take all economics.
Not at all.
Around that. There is not enough capital in the world to pay all the claims. Insurance, the scalable, the beautiful business element of insurance is the law of large numbers, but there's a cap, right? Like, I worked at a carrier, a global carrier, where our cumulative global risk, if you add up every policy, was in the trillions of dollars. But they basically, a $5 billion event would have knocked them out of business.
Right.
That's the scaling benefit of insurance with the law of large numbers.
That's
but
right.
that is just absolutely, it's a ginormous exposure that's out there, and we're trying to maximize like a small pool of funding to optimize, you know, how that's going to go.
Or said another way, if you took the top 10 carriers in the United States and examined their market share, they all have single-digit market share. There is no one insurance carrier or risk provider that has an exorbitant amount of market share in that business, and that's probably a good thing.
It's a good thing. Yeah.
It builds resilience in the
thing.
system, to be sure.
That's right.
Yeah, it protects the system, right? And so that for insurance, like, there is somewhat of a social obligation, right? Like, there's an element of that, of like, hey, we're supposed to be to protect you when things go really, really bad. Yes. You want to say hi? Say hi. Okay, go back in. Yeah. I know. Sorry. There's that element of like, it's supposed to protect society, right? And we have an entire regulatory structure to make sure that that happens, and things often go bad because there is not enough money, right, to go around. And so how do you manage all of that? There is no right answer. It's what's most optimal to do that. So any investor like, and I've seen this so often, like you start to pitch to an investor and they're looking at the TAM, and I'm perplexed by that, because it's like that TAM is not available. Like there's not enough capital to get that TAM. I'm looking for a sliver of that. And
yeah, people think marketing is just something that happens, but it's like expensive.
Marketing is expensive, the claims are expensive, and then we get back to like there's only like this much money left in the system. So it comes down to, from an investment standpoint, you kind of get back to like where we started. Insurtech as an investment, the vast majority of them are not going to be the next Uber, or like they just don't have that potential, right? So investors really got to damp down their
expectations
on these things. The expectations are just absolutely ridiculous. The lemonade thing was just so out of the ordinary, because they were a carrier that was getting paid like a broker, right? They were using their premium as revenue figures and like showing investors the premium as revenue. But the lucrative element of the business was the 25% take on that. That was very deceiving. Like to me, it was like, that's one way I saw the management team deceiving investors. It's like, holy crap, they got $250 million of premium and they're growing at 100% a year. It's like, yeah, but they're only getting 25% of that, right? And if they need to grow so much faster at a $10 billion valuation of 25% of 250 million, like that is a ridiculous expectation for what this company is going to do. So that was my big frustration, Tony.
Well, and I
don't think that's
the
capitalist.
I think the Insurtech revolution is going to be similar to the demutualization revolution, because mutual's not a silver bullet to taking care of customers. It turns out that when there's a big pool available and you have management, they find out that they can have private planes and pay themselves a lot. There's some pretty good Boston Globe articles from the early 2000s about this.
That's right.
But like the demutualization revolution was basically a governance revolution in insurance.
Right.
And you know, whether you were a mutual or a stock company, I think you ended up having to have higher standards of governance after that was happening, because you know, as we all know, asset managers have a little bit more of a hammer than policyholders do over their holdings. And then I think the Insurtech revolution is going to put pressure on insurance companies, even if these Insurtechs don't become like the big insurance companies, to I think like what you were saying, Nick, about having better customer experiences and being, you know, companies that develop technology that's eminently available and make it available to their customers. I think we'll see the risk industry become like a little bit more sophisticated because of this like incoming force that is, you know, probably a lot of press noise, but also some reality.
Will the VCs get the 5 years from now or whenever eventually like understand, okay, there is no insurance play that exponentially that can provide exponential profits that the way that we want in our business? Will they just walk away from insurance investments? And if so, no, they won't. They won't learn the lesson.
I hope not. They won't, but no, I hope not.
No, they won't. They won't, Tony. I think we're already seeing a change. Some of the insurance, you know, the internal insurance venture pools, haven't spoken to them recently. There is a I think, a dynamical change that's occurring. And I think one thing that they are looking for is to try to figure out how to potentially complement elements of their business with the tech, right? So it's like, we'll make this investment in you, right? Sure, like, we want you to succeed. One way we can guarantee you succeed is to bring you in-house, and, you know, we'll act as one of your customers around that, or, you know, figuring out like how 1 + 1 = 3 in
Sure.
that kind of dynamic. But I think deep down though, I think they do still want like the massive returns, but I think they're coming to grips that for like a lot of the risk bearing stuff, it's just not possible.
Tony, I think what I hear you kind of asking is this question around, let me back up. I think we all are aware that legacy insurance carriers, for example, have their own CVC arms. They're making lots of investments in the Insurtech space. I think that's appropriate, and there will be winners and losers, as there should be in that element. I think we've all seen that there has been a lot of money that has come from outside the domain of insurance, looking for either quick wins, fast wins, or, you know, to Roman's comment, you know, the casino element of perhaps a quick turn, something easy, and you know, people kind of getting over their skis a little bit and not having the expertise of the risk that's actually inherent in our broad industry, right? I'm just speaking on a very broad brush perspective. I heard Nick earlier use the phrase or the term, you know, cost of goods sold. People need to understand this is the only, or one of the only industries where, as an insurer, you know, a capital bearing insurer, you, at the point of sale, you never know what your true cost of goods sold really is. And that's fundamentally different than so many other businesses or enterprises. So I hope that there is continued investment in our industry from responsible players. I guess my area of concern is whether we'll still see more people kind of getting outside of their domain of expertise and making very large investments, and then thus inflating the value, either in the private or public market, of companies that have a technology bend that are trying to improve our industry, which is called insurance.
Oh, that probably will always be one of the costs of being in our type of capital flowing system, is that herds will run, and many of the members of the herd will run over cliffs. But ideally, like, it'll be like what happened in banking like 10 years before insurance, where people realized that building a bank from scratch wasn't going to knock JP Morgan off of its tower or whatever. And instead, you had to build things that were going to be useful components for these companies, were addressing some need that nobody was thinking about, and like actually finding like sort of blue ocean strategy style value innovation opportunities, instead of just saying like, with VC money, then we will be, you know, X. And who knows, I'm actually pretty interested in like some of the, you know, decentralized finance stuff in insurance and banking. But I think there's going to be interesting things that happen there, especially the ones that aren't venture funded. Who knows what regulators and, you know, the FBI will do about some of those things.
I was wondering how long it was going to take for someone to bring up the blockchain here. I was just wondering.
But I think there's potentially interesting things there, just like really at the fundamental level, instead of like in the venture, if we're talking about like venture investment and Insurtech ecosystem.
You know, I don't have predictive powers. That's probably a very good thing. But Tony, when this conversation started online several months ago, you know, your comment was, you know, I don't think that we should, you know, care whether Insurtechs are good investments or bad. And I think this week has brought forth two really interesting news stories with two very different paradigms, right? You have the root news, which is terrible. No one wants to see our colleagues without jobs, 300+ jobs eliminated in claims and sales and customer support roles. A statement from Root, which I don't know anyone at Root. I'm not bad-mouthing Root, but you know, their comments were, you know, inflationary pressures and the continued COVID-19 pandemic have put pressures on their business. Okay, and then we also have Travelers, a company coming out saying earnings off the charts. We're getting a rate. We're finding efficiencies on writing new business, right? A 125-year-old slow, stodgy, old legacy company doing really well. The shares went up. It was great news. Everyone could celebrate. They're both Insurtech companies. You can't say that Travelers is not making investments in technology. It's just that we see them through different lenses. And I think we should care for both. We should care in both paradigms that those enterprises are doing well, because it feeds back into the thing that you said that you were concerned about, right? Our policyholders being taken care of, our claims being paid, and on the employee level, are people being taken care of and treated well. I think people are waking up. If you're a Travelers employee, you feel pretty darn good that your job's not going away tomorrow. But if you're working for Root, it's a new day.
Yeah. Without a decent return, you can't take care of 1 and 2, right? And so you need all 3. It's extremely important to have all 3. And I would say to anyone that's listening, that's like on the early stages of a Insurtech, like, I think you need the third part. Like, you need to have returns or have a route to profitability pretty early on, because I think we aren't stupid. Insurance has been around for a long time. It's almost like these folks are just like just discovering that you can grow quickly in insurance. Like, no, that's been around for a long time and it's never worked, right? Like, we've already learned that lesson. These technologists come in and it's just like, oh, we're going to grow really fast. And then we'll flip a switch and we'll be like Amazon. Like, that doesn't work. And I think you see the signs of it with something with Root, in that that was pretty quick, right? And they could be in a death spiral here where they lose the rest of it as well. So you have to have that profitability return element very early on, because it's got to feed the machine so that you can keep paying claims. You can pay more claims. You can have more policyholders and take care of them, and you can take care of your employees. Because I'm with you on that. They are indeed a stakeholder in this, and I don't think you can get profitability without taking care of your policyholders and taking care of your employees. It's symbiotic ecosystem between those. And so I think that is a very important element, Tony, that we have discussed in the past about things around capitalism. And what we learned about capitalism in the 20th century was, once we got to the latter part, there was a pivot towards, we got to do better, right? We need to be better stewards, treat our stakeholders better, our customers and our employees. And I think the technological revolution really led the way there. And that is a good thing. Lemonade and companies like that, they brought a lot of value. There's no doubt. Roman, to your point, everybody was watching them, and now you got even the big companies are trying to minimize the number of questions they ask, try to make it easier, reduce the friction. They have definitely brought value to the table, and that's a very important component to the whole equation.
Yeah.
Well, my hope is like that the next revolution after this like technology revolution is the risk reduction revolution, where claims departments are actually talking to underwriters about why bad stuff happens, where people are starting to figure out, like, whether it's reinsurers, insurance companies, or VCs, like investing in things that are going to actually change the risks that are unfolding. Because there's so much to be done there beyond just investing in like, oh, let's start some more insurance companies. There's like real work to be done preventing flooding. There's real work to be done like making buildings more resilient to wildfire.
Absolutely.
Issues.
Yeah,
for sure.
And there's like actual, not only like,
and beyond.
Totally right. And it's not just nonprofit government work. There's money to be made even today in this stuff.
So Roman, that gets to a thesis that I have, right? So if we talked about that dynamic of the combined ratio, and one of the problems that insurance companies have recognized over time is that, there's a difference between a loss ratio and loss cost, right? So loss cost is the amount of losses that you are going to face on a particular amount of exposure, and loss ratio is the amount of loss you would face to the premium that you're charging for that. And I think insurance companies have recognized in the past that, yeah, of course, they want to reduce the loss cost, but it was almost like it was very imperfect that they would reduce the loss cost and be able to reduce the loss ratio. A lot of times they get the loss cost reduction, but they have to turn over that benefit back to the policyholder, and the loss ratio would be right back in the same spot, and they're right back to where they're started. But to your point, Roman, I think that's what when I started this podcast and I talked about how technology, we hit that inflection point with technology. Not only is it changing how we operate our businesses, it's changing the exposure. So the amount of technology, right? Whether it's, look at all of the sensors that are in cars that make cars so much safer. Like that can have a dramatic effect on loss costs. On the other hand, we have cell phones that are causing distracted driving. But I think of like property insurance with these smart devices. Our ability to reduce internal water damage, we can almost drive that down to zero.
Like
insurance
today,
companies could lead the way on that, and they're sitting on their hands because they are like, well, who's going to pay for this thing, right? And I had a really interesting conversation with a private client person a couple weeks ago who had a $100,000 water claim inside their home, and one of the big private client insurers, as they were adjusting the claim, said, hey, as part of the claim, we're going to install an automatic water shutoff. And he's sitting there scratching his head. He's like, okay, that's great. Why wouldn't you put that in before the claim? That was a $100,000 claim.
Too late.
So Roman, to your point, that in that combined ratio, one thing that we do have is if you can figure out a way to reduce the loss cost and the loss ratio, right, while maintaining the business, right, that's a win-win for everybody. The customer wins, you win, society ultimately ends up winning, especially if we can figure that out for like cat, right? You know, stronger roofs and you know, less wildfire risk and stuff like that. So I'm with you 100%. My thesis is the insurance company, the Insurtech insurance company of 10 years from now, I just don't see a market where a company can market themselves as like, hey, buy our insurance. Done. No, it has to be buy this thing and insurance comes with it, or buy our insurance and we'll bring all of this risk management to the table for you as a benefit, right? I think embedded insurance has to be the wave of the future, because by itself as a monoline product, it's an ugly product.
Well, and the big question is how to get it to actually happen. Like the way that the pressures are gonna come in for it to happen, I don't think are the same with the Insurtech revolution. There has to be other pressures that will force people to engage with the actual risk piece. And I don't know what those are going to be yet. I'm super interested to find out, but it's not clear how that's going to unfold, I don't think.
Well, I think in the category of cat, like Nick was just saying, I think you're going to start to see, well, I mean, you already have seen large legacy carriers that write property insurance and other lines feel the effects of, whether you want to call it climate change or not, whether it's you know, wildfires or rising seas or other factors. I mean, it's starting to hit the bottom line, and it will be interesting to see whether those entities jump into the fray to try to mitigate some of those longer term costs. I mean, that's a whole other podcast probably.
James, and I've been so careful to not say the word climate change to avoid a 45-minute Nick getting on his what's it called, milk cart
Oh, okay.
My soapbox.
His soapbox.
Is Nick a climate? Is he a climate denier? Is he a denier? No.
Well, James, not to get too political, but if you don't fall in line, you're automatically a denier. even if you have very rational viewpoints on that. But so James, to what you just said, right? AIG Private Client just announced they're going to non-renew their entire California book.
Correct.
Right. So if you're a niche player, like I fancy myself to be, I view that as an opportunity. The big player can't do it. They're throwing up, they're waving the flag, right?
Right.
They
the flag's on
So,
fire. That's why they're waving the flag. Yeah, the flag is on fire.
It's over for them, right? And so, Roman, like, to me, I think there are a lot of really smart people in insurance. That was one thing always, like when the technologists were coming in, it's like, you guys think we're dumb. We're not dumb, right? What we are is not creative, okay? So I think, to Roman, to do the things that we're talking about here, I think there's a lack of creativity. And I think a younger generation will potentially bring the creativity in. I think the way technologists think is very creative, and I think that's starting to make an influence. And we do need a different way to think creatively about different business models, different product design. That is where I think we have ultimately fallen down. That's been exacerbated by poor technology and other things. But I think at the end of the day, insurance just happened to be one of those businesses where you didn't have to be different. You could be a commodity and still do fairly well. And I think those days are over. And I actually worry about like the county mutual, right? Like, what business do they have actually being in business? They offer nothing different. They're going to really struggle, but they have a balance sheet. You can't disrupt that. So how do they make it available to the public? It's what you said. It's like they can rent it out to some enterprising firm, make it available, and that enterprising firm will get them a better return than they ordinarily would have been able to get themselves. And that enterprising firm can generate some return for themselves. So that is my hope, right? But I think we need some creativity, big, massive paucity of creativity in our industry.
Well, and so many of the issues, the creativity-based issues, require big players to engage with them, because to the California question, like, lobbying and public relations are required for a lot of the business models that could exist in order to make them possible, because the regulatory environment, it sort of makes people feel like they can't be creative, even though that's not exactly a great excuse, potentially. And so I think it's most interesting with the risk curve stuff, especially for the big players to say, like, okay, instead of leaving California, what could we do here? Could we help people build houses that just can't burn down, or like Hobbit style houses that can like be built on the ground level? I don't know what the answer is, but it
might be an economic answer. If you look at homeowners in Florida, right? I mean, that market is just falling apart, right? And the state has to step in and provide coverage. And from my understanding, I mean, the rates the state is charging are 3 times what the private markets were charging. So maybe it's a mispricing of risk. So at any price, would a market enter a space like the California market or Florida? I mean, maybe it's a pricing element. I don't know. Technology should certainly play a role here, and better risk selection should probably play a role. But we all have talked about, it's just endemic to the world that I'm originally from. Sometimes risk gets misplaced, mispriced for long periods of time. I mean, right now, cyber is under a very a tight amount of scrutiny. Is there any price by which the private markets should be financing cyber risk? The answer might be absolutely, positively no. I don't know. Is that because of risk selection, or is it just something that can't even be quantified? Because back to Nick's point earlier with talking about his background, when you add up the cumulative value of what those policies are trying to cover from a risk perspective, it just may be uninsurable. I don't know. It's interesting.
Yeah, I think like that's such a massive problem. We could talk about that for hours. It's just such a massive problem, and I think part of it is that we're looking for like a scalable solution on day one, and I think that's part of the creativity problem, right? So, you know, AIG is kind of stuck, right? Because they already had a big book, but there are players in the California market, and I believe that they will be successful, and they're just kind of nibbling around the edges. James, you said pricing. The state of California, the Department of Insurance, would not allow carriers to use models for pricing, right? So part of it is, I would say definitively, pricing became problematic because in a market environment, right, where you're only allowed to use experience, you know, in an admitted market, that's going to be problematic for dynamics that are rapidly changing. And so, but we have enough tools in our toolbox, right?
Like, I've long made the argument that, I've long made the argument that in insurance, we don't need so much more new technology, but we certainly could benefit from better regulations. Nobody wants to go to a conference or a panel discussion around insurance regulations. They all want to go to a panel discussion around Insurtech because the tech thing sounds cool.
Yeah,
but the reality is,
But if you put a gun to my head, right, and you said, Nick, could you build a small book of wildfire risks in California and make it profitable? Absolutely, I could, right? Could I do that at like a massive scale? I don't know. I don't know. I'm not sure if that's possible, but there are enough tools that I can go in and just say, everyone's non-renewing this risk or won't write it, but this isn't what everyone thinks it is. I'm going to pluck that out. I can build an island of misfit toys around that. I just don't know if I can do it at massive scale. That becomes a problem. And that's another reason why you need hundreds of insurance companies to participate in, so you can spread the risk out enough. But if the state regulatory environment's not willing to play, right, and not willing to allow the risk to get into the premium, you got a problem. And we especially got a problem, Tony, if you're right around things around climate, we got a huge regulatory problem because the regulators are adamantly going to put the brakes on any sort of climate signal getting into premium, right? They're going to want the insurance companies to absorb
an
that.
adverse effect of then transferring that risk out of the private markets right back into the public markets, right?
Well, and I think you end up with a problem of thinking about it from only the insurance perspective instead of like the society and risk perspective, because those risks, like there are probably things that society needs to do to mitigate them, and like business models other than insurance that need to be put into play in order to like either help people move, choose not to live in these places, build different types of houses. I don't exactly know what the answer is, but it's not exactly an insurance problem like all the way around. It's partly an insurance problem, obviously, but it's also there's
Nick
other
paid me to say
Nick
paid me to say that sounds like socialism. I don't know.
Well, so I think Florida provides a good example of what could potentially be done, right? So, you know, Hurricane Andrew was the big inflection point here in Florida. And as much as the Florida market is really messy, can you imagine how worse it would be if there weren't a series of building code adjustments? And so my view on things around climate change and how it affects insurance, my view around catastrophes and how we ultimately figure out solutions around insurance is that we've evolved so much as a human species that our technology can rapidly outpace the things that are changing around us rapidly. We can change the building codes. Do the people that are governing, can they move fast enough to do that? Are they willing to change the building codes? In Florida, it was existential. They had to do that. If they didn't, like the insurance market right now is almost unmanageable here in Florida. It would absolutely be unmanageable if they hadn't made those building code changes, but those building code changes have made a massive improvement on a functioning insurance market. So to Roman, to your point, there is a role for all of those stakeholders, and can we all unite on those things? I'm not sure. There's such a lack of distrust amongst stakeholders. Everyone thinks the other is out to get them, and we lack the ability
today.
To progress.
Tony, show that shirt. Show that shirt, Tony. There it is. Is that Bernie, Tony?
Sir, yes, a proud Bernie bro. I will sadly never see him as the candidate in the general election, but proud Bernie bro.
Well, I think the funny thing is, like, the interests are actually, if you look at the numbers, even aligned. Like, society would prefer like wildfires and hurricanes not destroy houses, and so would insurers and reinsurers. And it's a matter of like changing the conversation to be about how do we get those better outcomes to happen in ways that don't like violate the way that each of these actors operate, which like you were talking about, it just requires a little bit more creativity than the standard, like, you are bad versus like, you know, you are out to destroy us kind of mentalities.
Well, it requires a long-term view. And I think as a society, our financial markets for sure, but as a society, we're so bad at having a very short-term view.
Agreed. Completely. Humans are horrible at long-term prediction, long-term forecasting, long-term planning. They're just, it's hard because we live in our own drama every day, and when you're weighting those things, like the weight of today just matters so much more than the weight of tomorrow. There will always be so many things pressing, and our ability to prioritize things gets very challenging. But Roman, I am privy to some things that are going on that I think would be very pleasing around what you and Tony just described. I think there's some momentum around really global enterprises that are figuring that out, that are saying, you know, our long-term business model really depends on long-term stability of these risk markets. And so I think they're leaping over the entire insurance ecosystem and going down to truly the community level. Like, so you can think of like Paradise in California, going down to that kind of community and just saying, we are willing to put our balance sheet on the hook to help you get around this. But in order for us to put our balance sheet on the hook, you need to make a long-term commitment to us, but more importantly, to the solution of, you know, trimming the trees or whatever it is that's going to reduce the risk.
Raking the forest.
So that alignment of interests, right, and getting everybody's time scales to the same prioritization, I think. I do think, Roman, like, we as insurance professionals, we have influence in this, right? It's a lack of creativity or a lack of gumption. I don't know what the word is. It's a lack of
intestinal
fire in the belly. Yeah, to do that, because, like, you know, we're worried about like making quota for this quarter and this year versus that long-term thing. But I think we all agree on that from that particular perspective.
Okay, we're running out of time here. I want to get you guys out on time. Fantastically interesting discussion. Thank you, everybody, for agreeing to do it. I 4 people podcasts are much harder to schedule than normal, so it took me a couple months to get it down. When it goes live, I will tag everybody on LinkedIn. But really fantastic discussion. Thank you, everybody.
Tony, thanks for having me, and Nick and Roman, thanks so much. It was great.
Great talk.
Great conversation, guys.